All right, hey everybody, Mike Shorr here. All right, like I said, there was a question about what a straddle is, and I thought uh, now that the markets have calmed down quite a bit, they raced up, they pulled back, they're holding on to their gains, except for the Dow, which is down 10 basis points at this point. There was a question on what a straddle is. And so I was gonna do a quick video on what a straddle is, and while we're at it, we might as well talk about what a strangle is because they're very similar, but there's a couple important differences. Okay, so let's just take SPY. Obviously, anything that has options, you can do a straddle on it. I'm going to clear out the Sims. Okay, and let's go out to regular April options, which are the 18th. Of course, the SPY has a billion different expirations. Okay, so a straddle is buying a call and buying a put both on the same strike. And typically, it doesn't have to be this, but typically it's going to be whatever's closest to at the money. So right now we're trading here at 282.73, which technically is closest to the 282 half strike. So you buy a call and you buy a put. I'm gonna do this from the debit side because you're not gonna, most of us, if not all of us, are not gonna be able to sell straddles because that's gonna be selling naked premium, meaning that you could have unlimited loss, and most people aren't able to do those in their accounts either because of the type of account that they are or the amount of margin that is available or not available. Okay, so buy a call, buy a put, same strike, same expiration. So the risk chart's going to look like this. I'll take this out to April expiration, which is on the 18th. Excuse me, 18th, Mike. Oh, because we're closed on the 19th, that's why. That must be Good Friday. Okay. And this is what this looks like. You can see that long call is going to be this effect of the profit curve, and long put. So what do we need to have happen in order to make money doing this? There's two things that could happen. First, let's go over the Greeks that are associated with this. This one happens to have a small positive delta, just because we're not trading exactly at the money, we're slightly in the money. So the call is going to have a slightly bigger delta than the put because we're slightly in the money. Right now we're 13, 14 cents in the money on the call side. There's going to be positive gamma, right? If you own options, you're going to be long Vega and you're going to be long gamma. The theta can be expensive, right? I mean, the price of this thing is let's see, what's the market on this? The market on this thing is 738 bid at 743. So each one lot would cost $741. This is going to decay against us being long nearly 80 cents a day. And then we also have a sensitivity to Vega. Our Vega is plus 10. So two things can happen for us to make money here. One, and the easiest, we move. Which direction? I don't care. If we go up, we make money. If we go down, we make money. We need movement for a straddle to work. Or at least that's one thing that can make it work. The other thing that can make it work is this Vega portion. If implied volatility were to go up, for every percentage point that it goes up, so for example, 11.5 to 12.5, we would make 10 cents. Conversely, if volatility went from 11.5 to 10.5, we would theoretically lose 10 cents. So you would do this in two cases. One, if you're looking for a way to get long implied volatility in a given underlying. Because I think implied volatility is too low and I think it's going to go way higher. And this is the way to get some bang for your buck. Or I think that we're going to move. I just don't know what direction, Mike. I think that we're sitting here and it's either going to go up or down 10% from here within the next month. Okay, a straddle will be the way to do that. Why don't we do straddles? Well, mostly in this room because we are directionally trading these options. We don't do iron condors in here. We do directional trades, day trades and swing trades. So me just saying I don't know where we're going to go, but we're going to move. It's not part of our charter in this room. The other thing is if you're wrong with a straddle, it can be very expensive, right? This thing's decaying out 80 cents a day. You need that movement. And especially if implied vol is on the high end of the spectrum, you could sit here and have decay work against you and have vega work against you. But that's what a straddle is. And like TJ said, if we're sitting here let's just say generically this thing is trading, let's just say it's trading 750. So if it's trading 750, and we're trading 282.63, well, if we get 290.13, that's my break-even point to the upside, which is the current price, plus the premium that we had to pay. So you need to get above 290.13 and then 263.58 minus $7.50. Or if we get below 256.08. I need to get those moves at expiration or I guess before to become profitable. Now, of course, the price of that straddle can go up and down just due to supply and demand. And that's kind of what you're hoping for. But that's a straddle. Okay, any question about any questions about that before I move on to a strangle? Strangle will be an easy conversation if that's clear. Okay, strangle is just like a straddle, but where you are buying a put and buying a call, but you do it out of the money. So here's my straddle, and instead of buying the at the money call and at the money put, I buy an out of the money call, 287.5. So basically $5 out of the money, or 277.5. So I buy both of those. Same thing, the same type of profile. It's going to look similar. It's not going to look exactly the same. It's going to look similar. Let me push this out to here and then get rid of that. So you can see that it looks the same, except this is flatter because you need to get through the strikes and the premium that you paid before you become profitable. Same type of thing. This one happens to be, oh, this isn't right. Oh, because this is at expiration. I was like, how are all those zeros? It's going to look a little bit different here. It's going to, theoretically, this should be about a zero delta, but there's some rounding error in there, and we're slightly in the money on the call, so it's going to have a slight positive delta. But the same thing, I'm long gamma, I'm short theta, and I'm long vega. Where before, you saw that there's a lot more decay with an at the money option than there is with a $5 out of the money option, right? Theta was about 80 cents. Here it's 11. And then our vega number, I can't remember on the straddle what it was. Was it only 10? That can't be right. But your vega number is going to be bigger with the at the money straddle. Hang on, let me put this in here. Hopping around on me here. Clear those out. And then if we're sitting here at the 82 half line, our vega number is 63. Higher with the straddle, but not that much higher, but higher. Okay, so that is how those work. Basically, they are ways to either we're going to move a lot and I don't care and I don't know which way, or I think implied volatility is low and I want to figure out a way to get myself as much vega as I can. Buying a straddle or a relatively close to the money strangle is the way to approach that. Like I said, this isn't something that we'll do in this room, and we don't do in the other room just because they're darn expensive, and when you're wrong, they're really expensive, and it hurts your account. But that's what those are. All right. Any questions on that? Like I said, I did record this. It's about a 10-minute long video. So why not use a straddle for earnings? Because what's going to happen to a straddle on earnings? What does implied volatility do? The question was, so why wouldn't you use a straddle for earnings? What do you need to have happen? Well, for one thing, implied volatility is very high. Here we are. You're not going to have earnings here. Let's look at just like Facebook or something like that. Implied volatility is high right before earnings. Here's earnings. Is this where you want to be buying Vega? Do you want to be buying Vega here? You want to buy Vega here? Do you want to buy Vega here? So you know that you're going to get smacked on your Vega position. This is not where you want to buy Vega. You want to buy Vega when it's low. So you need a bigger than priced in move. Now, of course, you can make a killing on being long straddles going into an earnings report if you get the move. For example, this one in Facebook, when we moved 23% in a day. Whoever bought straddles before earnings absolutely hit a grand slam. But remember, there's a priced in move for a reason. There's a generally agreed upon know where what this thing is expected to move. Can something happen that makes you move more than the expected move? Of course. But when you're wrong, you're going to get smoked if you buy straddles and you're not right. Yeah, I mean, if you could predict when implied volatility goes up, well, that'd be great. Hey, volatility's low here. I'm going to buy it. You were absolutely right. Buying straddles here, and you probably didn't even need to move very much. You were doing just fine. But buying straddles here, what do you think on a move like this? Buying straddles here, you got smoked. Buying straddles here, you got smoked. But if you have a reason to believe that we're going to get a bigger than expected move, and you need a significantly bigger than expected move. Not to say that it can't work. Of course it can work. Any trade that you do can work. Just a lot of things need to fall your way for a straddle buying into earnings. You need to become profitable to have that work. Okay, I want to get this video out to you guys, so I'm going to stop here and get that out to you. Good question. Not something that we're going to do in here, but it's important that you know it. Thanks for that question.